Hey everybody, welcome back to 5 Minute Financial Markets. Well, the third and arguably most important day of the biggest week of the year came and went with relatively little bloodshed, which in this 2022 bear market, I'll take that as a win. Today was the FOMC rate hike decision. As expected, it came in at 50 basis points or 0.5%. But look at the price action on the day. So we opened about $3 higher than we closed yesterday. The market was looking good, relatively low volume, but still trending up to this 405 level, and I've said it in almost every video, the $5 increments on the SPY are such key levels of support and resistance. It hit 405, bounced off, hit 405 again and bounced off, actually broke above it for about a half hour before the rate decision came, had this little breakout, fake out about 2 minutes before the announcement, and then boom, right at 11 o'clock Pacific, when the Fed decision came, we sold off by 1.25% in about 3 minutes. Now, I don't really know what this was. Maybe it's just a buy the rumor, sell the news kind of thing. Everyone knew they were going to hike 50 basis points. There was no surprise at all. So I don't know what would cause this massive sell-off in the first couple minutes after the decision. Then at 11:30, Jerome Powell started speaking with his prepared statements. The market sold off even further, came down to the low of the day right around 396, and then started to recover during the Q&A session afterwards. We ended up down about 0.2%, really not that bad, all things considered. But it definitely does put into question, where do we go from here? Looking at the daily chart, we're still in this upward trending channel that we've been in for the last 2 months. You see before the rate announcement, we came back and tested this yellow trend line. This is the big resistance trend line that we've been seeing all year long. We haven't gotten above this trend line all year except for a brief breakout yesterday, and we rejected quickly back in. But here's sort of where the rubber meets the road. Now we've gotten all of the big news items baked in. We know what CPI is, we know what the rate decision is. There's really no big news items for the rest of the year, so the market's just going to be trading on sentiment and technicals. And we've got two opposing forces that are going to come to a head in the next 5 days. We've got this upward trending channel, and we've got the downward trending resistance line. 5 days from now, those two will meet, and the market will have to make a decision one way or the other. I expect it to be a big move one direction or the other, but at this point, we don't know which way. Quickly looking at the VIX, the volatility index, we broke below that $22 support resistance level, back down to 21, and that's a good sign for the market. We like to see lower volatility to have sustained rallies, but it also kind of makes sense. Implied volatility was elevated heading into these big news events, CPI and FOMC rate decision. A lot of people were buying options for protection, which drove up the price of implied volatility, which is the VIX. So now that those events have passed, the price of the VIX has come back down to its natural level around 21. We'd really like to see it break back down below 20 to see a sustained rally in the S&P. Here's an important chart we haven't looked at before. This is the futures contract on the Fed funds rate for May of 2023. So this is what the market is currently pricing in the Fed funds rate in May. Why did I choose May of 2023? Because that is the month that the market is anticipating the Fed to have peak interest rates. In other words, the Fed's going to keep hiking interest rates until around April or May, and that's where the market is currently pricing in that they will stop the rate hikes. But you can see here that's down over the last several weeks from a peak of about 5.25% back down to 4.86, and it's in this downward trending channel right now. We had a big down day yesterday, and then indecision today. This is a very good sign for the market if this interest rate keeps heading lower. That means that if the market is pricing this correctly, the Fed will have to raise rates less and less as time goes on. We definitely have to consider the possibility that this could be a bear flag forming and we're about to have another big leg higher. I kind of don't think so though, for a couple of reasons. One, much higher volume recently on this move down. Now, that could just be because the contract is getting closer, and the closer you get to a futures contract, the more volume will be traded. But I also do think that inflation has peaked. We are on the way down in terms of inflation numbers, and that does tend to be bearish for these federal funds rates. Lastly, I want to take another look at silver, which had another nice update today. I do still expect some consolidation. As I mentioned yesterday, the RSI, which is a momentum indicator, is up in the slightly overbought area, so it would make sense to see some consolidation here before another move up. Also, just a little note on technical analysis. So I've had this parallel channel that silver has been in. It broke out here, rejected back into it, and now it's broken out and confirmed outside of that channel. So I'm going to go ahead and just copy this parallel channel that I have and put another one right on top of it. The same slope, same direction. I'm just going to layer it right on top, and look what happened. You can see that there's already resistance at this midline. We had two rejections there. We had a close there and open there. And you see this often with these parallel channels. When it breaks out of one, it goes into another, and the same support and resistance dynamics take place, just shifted higher or lower. That's all I've got for today. If you enjoy this content, please hit like and subscribe, and we'll see you next time.